Good morning, traders. It's Tuesday, June 28th. Taking a look at the charts, we've got the SP 500 futures daily chart here. You can see yesterday we continued to sell down and close down near the lows. Very bearish close on the market. Everyone was kind of running for the door. We saw some pretty massive panic in the market yesterday. If we look at the NYSE panic selling ratio, the volume that we follow, which was about 12 to 1, meaning there's 12 sellers to every one buyer. And anything over 3 is usually a short-term pivot low. That's usually a short-term extreme level where we see a market bottom. Yesterday we had 12, and anything over the 9 level is usually a significant pivot low, and we usually see the market rebound the following session for a multi-day bounce. So that's where we're at today. We've got a pretty strong bounce taking place, about 1.3% up in the SP 500. We've gone from an oversold level, and now we're getting an oversold bounce. We're probably going to come back up, test this 2040, potentially 2060 area or so going forward. So this, of course, we had this breakdown right here, which is where we got some follow through yesterday, and now we're probably going to see a little bit of a bounce. And if we take a look at the cycle here, this blue cycle, the short term, you can see we've had a little bit of a pivot low here, and it shows us having a bounce for a couple days. And if you're to do a blend between the pink, the magenta overall trend line with the blue, you kind of get this dark gray line kind of price action. So you can see we're looking for a little bit of either a consolidation here, a little bit of a pause, or we're going to see more of the blue line. We're going to see a bounce back up to test this kind of breakdown level. So either way, I think we're going to see a little bit of strength carry over for a couple days as this oversold market condition just has a bearish kind of bounce or pause before it continues to go and potentially really break down with some big follow through to the downside. So that's what we're looking for going forward. And ideally, in a couple of days, we may have a great short opportunity to short the market using an inverse ETF and or potentially do a VIX play where the market could have the big follow through to the downside, and we see the VIX spike much higher than what we saw recently, even though we did see a pretty decent spike in the VIX. Now, taking a look at the VIX, let's just pull that up real quick. Here is the VIX down about 10% this morning. You can see it did pop all the way up to the 26 level yesterday, dropped about, it was down about 10% yesterday. It's down another 10% again today, kind of fading back down. And I feel like we could see something where we see it fade down and consolidate before we see another big run up, one of these big spikes. It'll bring us back up to the upper end, to the upper 20s, 30 area, or potentially even higher with the next big bout of selling. Now, taking a look at the flip side, yesterday bonds had a massive rally up about 2.5%, which is great. We've seen a huge move in there. We did get long bonds. We've seen that continue to expand and extend to the upside. Bonds are trading down slightly today. Let me go to the futures so we can see the current price action. Here's the futures 24-hour chart of bonds. Big move up. It's playing with resistance that it hit back here when the Brexit news hit. So it tested that level this morning, pulling back a bit, but overall still very bullish price action. Again, if we see equities have a bounce here for a couple days, we're probably going to see the safe havens pull back. So they usually move in the inverse. We'll see bonds, see gold, silver miners pull back, and then when the equities market starts to roll over again, we'll see money flow back in, and we'll see this breakout really start to take place. Now with bonds, you can see this price action, big run up. We've had a nice bullish consolidation, nice bull flag forming. More or less, it's broken to the upside, pulled a quick pullback, and then exploded up here. It's testing this level. This could easily just continue to expand and explode to the upside as fear grows. We'll see how that goes. Either way, we are long bonds and we're long gold, expecting much higher prices in the future. Let's just take a quick look at gold. Here's a chart of gold pulling back a little bit more today. Of course, had that big spike. Now it's consolidating. And I do feel as though overall we're going to see metals continue to kind of grind their way up. I think we'll see a little bit of a pause here with the equities market bouncing this week. But overall, I think we'll eventually see gold continue to grind its way higher. Looking at gold miners, GDX, again, we're testing, flirting this critical level. It is kind of playing with this resistance zone we drew here on the chart a year or so ago, a long time ago. Yeah, back in 2014, I drew this line and saying that this is a pretty critical line in the sand for any basing pattern. The market was trying to base, trying to break and firm up above this, and it never did. End up breaking down and moving down and putting in, I think this here is the bottom, and now we've come up with this substantial rally. The big question is, do we pull back and consolidate here for a while, or do we just break through this and continue to explode to the upside? The only thing with miners, it's a pretty dangerous pattern. It's very explosive. It could go either direction. We could see this expand and just continue to rip to the upside and never look back, or this could be a very sharp correction and we see a pretty major choppy price action going forward. So it all depends on how things unfold. Overall, I do feel as though gold miners and gold and silver have bottomed in their basing, and it's just a matter of time before miners really break out of this significant basing pattern and really start to expand and move to the upside. And the only one concern that I have is when we've seen bear markets in the past in equities, when things get really ugly and everybody has margin calls, we do have records amount of traders, investors using margin, meaning borrowed money. So when their investments start to go against them and their accounts draw down, they'll be forced to do margin calls, and all their positions will eventually be forced to be liquidated. And that's when we see gold miners get pulled down during a bear market. They can be under a lot of pressure. We've seen this happen in 2008. Gold miners got completely clobbered when everybody was forced, the brokers forced liquidation, and all these plays get sold off. So there is that fear down the road if things get really ugly. Not imminent. Usually we see gold miners hold up and outperform during uncertainty, the early few months of a bear market starting in large caps. But eventually, if the bear market gets really bad, we can see gold miners actually get pulled down with the equities market, while gold actually holds up and performs, which is why gold is more of the safe haven, much more conservative play, obviously, than miners. You don't get the extreme moves, but you don't really need huge moves like the miners with 3 times leverage gold ETF. You can get a lot of juice with a more stable asset class than the miners. Taking a look at energies real quick, natural gas. Just zoom in a bit here. Continues to explode and break out of this basing pattern we've been watching for a long time. It's really exploded up. Now it's into this high volume resistance zone, likely going to run into a lot of overhead pressure here. It's starting to get a little volatile. I wouldn't be surprised we see it pull back, consolidate. Overall, I think from the looks of it, natural gas is starting a new bull market, and it has put in a bottom, so I think it could base out over a long period of time and overall hold up very well and continue to go higher. And looking at crude oil up 3% this morning. This is the daily chart again. You can see we're holding up here, sold off, bounced, sold off, and we're starting to get a little bit of an oversold bounce again, kind of holding this level. This is right across this support, this previous resistance then became support, and eventually overall cycle analysis is showing a move down. So in the grand scheme of things, if we were to look at all the cycles here, let's just pull up the equities market. It shows overall the magenta, this pink line here is the overall market trend. It shows we got a downward bias for the next pretty much month and a week, about 4 or 5 weeks. We've got downward pressure kind of forecasted in equities. If we look at oil, we've got downward pressure also, which makes sense. If oil is falling fairly sharply, we're going to see downward pressure on the equities market also. And then if we take a look at the safe havens, here is gold. We see gold, it's still got upward bias. As long as these cycles are trading in this upper range, usually the market will continue to hold up and perform. So overall, we still have about a month or so of upward prices in precious metals. And then also we've got a series of higher highs and higher lows for bonds, even though we're getting a little bit overextended to the upside. Looks like we could have, you can see the short-term blue cycle here. You can see a little bit more of a pullback. And overall, bonds show that it's going to trade sideways to higher with higher highs and higher lows still going forward for another month or so. So everything is kind of showing, safe haven is showing a flow for the next month upwards, in equities, in energies, a flow downward in price action. Anyways, that's it for this morning. Talk to you in a little bit. Bye-bye.